Okay, negative 85%. When you see a massive drop like that for a major tech player, you really have to ask yourself a serious question. Is this the market's absolute biggest hidden opportunity, or is it just a ticking time bomb waiting to wreck your portfolio? We're talking about Globant. This was a company that was, not too long ago, considered the absolute crown jewel of digital transformation, and today, down over 85% from its highs.
Welcome to The Explainer. I am so pumped you're here today because honestly, we've got a truly fascinating puzzle to solve. Our mission right now is to impartially break down this complex tech giant's valuation. See, the mainstream financial media is really pushing this whole AI winner narrative, but when you actually dig into the data, well, there's a completely different story unfolding. We're talking collapsing growth, a massive lawsuit, shifting business models, the whole shebang. So we're going to cut straight through the headlines to figure out if Globant is a diamond in the rough or just a massive pile of code debt.
So here's our roadmap for the explainer today. 1. The 85% crash. 2. 4 massive red flags. 3. The deep value bull case. 4. Testing the investing legends. And finally, number 5, the AI automation paradox.
All right, let's jump right into section 1, the 85% crash. So we need to start by looking at the incredibly jarring disconnect between this company's theoretical valuation and its actual on-the-ground reality. The sheer scale of this gap is wild. Guru Focus calculates Globant's fair value at $209, yet the current price is sitting around $37. That's essentially an 80% discount. The idea of buying a dollar for 20 cents is obviously incredibly tempting. But we really have to remember that in today's market, AI stories do not automatically equal earnings. We need to understand what this company actually does.
Now, for those who might be unfamiliar, Globant isn't just your standard IT body shop. They build massive digital ecosystems. They've created these things they call AI pods, basically agile teams of designers, engineers, and AI specialists. And their big, sticky moat, they are model agnostic. This gives clients what is known as token sovereignty. In plain English, it means massive corporations can instantly switch between 140 different AI models without getting locked into just one vendor, like OpenAI or Anthropic. It's a brilliant value proposition for sure, and Wall Street absolutely loved the story. But, stories don't pay the bills. Earnings do.
Which brings us to section 2, 4 massive red flags.
Okay, we're shifting gears to the bear case now because we need to look at the serious fundamental issues that the mainstream media is just flat out ignoring. Starting with a massive drop-off. The growth engine is practically dead. Historically, Globant grew its EBITDA at a median rate of 27.5%. Fantastic, right? But over the last 3 years, that number has plummeted to a mere 3.3%. That is a devastating 88% deceleration. The reality here is that if you're buying this stock expecting rapid growth, you are definitely not getting it. You're paying for stagnation.
Let's break down the next 2 red flags. First up, the profit collapse. In 2024, they brought in $166 million in net income. For 2025, that estimate fell to just $103 million. That's a staggering 38% nosedive. The real-world fallout from that was 1,000 employees getting laid off just to stop the bleeding. Then there's the Latin American meltdown, and honestly, this is arguably the biggest issue flying under the radar. Latin America is Globant's home turf, yet Q1 revenue there dropped 9%. Management tried to blame the macro environment, but shareholders simply didn't buy it. This actually led to an active securities class action lawsuit alleging management lied about the health of the LatAm business throughout 2024. When that news broke, the stock took cascading hits of 28%, then 24%, then 15%. A fraud lawsuit isn't just a bad quarter, it is a severe credibility crisis.
And our final red flag is all about liquidity and transition risks. They currently have a cash ratio of 0.43. Basically, they can't easily pay off their short-term debts. And to compound that liquidity risk, they're in the middle of shifting their billing model from time and materials to fixed-price contracts. This is a huge shift in how they do business. Under fixed-price contracts, if Globant messes up an AI project or it just takes longer than expected, they have to eat those extra costs. Analysts, like the ones over at Jefferies, have warned that this dynamic is very likely going to lengthen the company's road to recovery.
Moving on to section 3, the deep value bull case.
But hey, every story has 2 sides, right? So why should we even entertain this stock? Let's take a calculated look at why that $37 price tag might actually be a completely irrational market overreaction. This is the crucial point right here. Globant is trading at a PE ratio of 12.5x, while its industry peers are trading at nearly 59x. The market is literally pricing Globant as if it's headed straight for bankruptcy. But when you look under the hood, there is a surprisingly compelling counter-narrative. So, Here are the robust green flags that the value bulls are pointing at. Aside from that massive 80% discount to its intrinsic value, their AI pod sales pipeline is incredibly strong. It's currently sitting at $352 million. They're aggressively targeting 70% of their top 20 clients with this new tech. And, perhaps most importantly, management is putting their money where their mouth is. They've authorized a $125 million stock buyback, which is a massive signal that they believe their own stock is deeply undervalued.
All right, let's head into Section 4, Testing the Investing Legends. Let's see what happens when we run Globant's numbers through the core philosophies of some of the greatest investing minds in history. Let's start with the father of value investing himself, Benjamin Graham. Now, using the Graham number, Globant actually has a fair value of $56.92. So at $37, it looks pretty cheap on the surface. But Graham demands stable earnings, and as we saw, Globant's earnings just crashed 38%. Plus, it completely fails his strict net working capital test. So for Benjamin Graham, this is a hard pass.
Next up is Peter Lynch. He famously loves the PEG ratio, which measures price to earnings relative to growth. If you look at their historical 5-year growth of 21%, the PEG ratio is an incredibly cheap 0.6. Sounds great, right? But here is the danger. If you evaluate them based on their current growth rate, which is just 3 to 6%, that PEG ratio explodes to over 4.0. Lynch would absolutely warn you that this is a classic growth trap. You'd literally be paying for a growth rate that simply does not exist anymore.
And finally, let's look at Warren Buffett. He's always hunting for a high return on equity, or ROE. Well, Globant's ROE collapsed from over 20% down to just 4.8% last year. In Buffett's eyes, that is a disaster, and it completely strips the company of any wonderful business status. However, because it's sitting at what he might call a wonderful price, Buffett might view this as a purely speculative cigar butt play. Basically, it's a cheap company that might have one last good puff left in it, assuming management can actually pull off a turnaround. He might buy it, but for sure, he wouldn't hold it forever.
Which brings us to Section 5, the AI automation paradox.
Now we're at our final verdict, and we really need to unpack the deepest irony of Globant's entire business model. It's a fascinating paradox, and honestly, nobody is really talking about it. See, the bull case assumes AI creates massive new demand for Globant, but the bear case, it revolves around this automation paradox. Globant's core business makes money by billing clients for human hours, but what does AI actually do? It severely reduces the need for human hours. So here is the paradox. If Globant's new AI pods are highly successful for their clients, they're going to actively cannibalize their own core headcount business. Actually, scratch that. It's more like they're automating away their own revenues. This paradox perfectly explains why their growth has stalled out so aggressively.
So what is the ultimate takeaway for you as an investor? Basically, you're looking at two very extreme outcomes here. If you're playing a long game, this is a pure speculation bet on management's ability to pivot away from their traditional body shop model and into a high-margin AI consultancy. The market is currently priced in the absolute worst-case scenario. If they can successfully execute this pivot, this stock is a potential 10-bagger from here. But if the turnover fails, the outcome could literally be zero. And in the short term, that ongoing lawsuit is going to create massive volatility that could easily drag the price down to $20. The crucial metrics you've got to watch like a hawk from here on out are the Latin American revenue recovery and that super dangerous cash ratio.
And that wraps up our analysis for today. But now I want to turn it over to you. We've gone through the 85% crash, the brutal red flags, the massive potential pipeline, and those stark warnings from the investing legends. So what do you think? Is Globant a deep value steal just waiting for a turnaround? Or is it a textbook value trap catching investors completely unaware? I would absolutely love to hear how you weigh the evidence, so drop your thoughts in the comments and let's get a debate going. Thanks so much for joining me on this explainer, and keep learning.